In a previous video, we touched on the idea that people don't usually make changes without a reason. So we wanted to explore some of the reasons an investor might consider incorporating alternative investments into a portfolio that also has some of the more traditional choices. Specifically, we want to put things in the context of a retired person who's making arrangements to produce ongoing income to fund personal needs for many years into the future, and go step by step through a demonstration of how using alternative investments might help to accomplish the goal. Let's start by assuming that our investor is going to retire tomorrow with $1 million in capital and a $4,000 a month budget to cover. We'll look at a couple of possible scenarios. First, we'll take a look at what might be reasonable to expect given currently available interest rates and the long-term average return for the stock market. We'll allocate 40% to stocks, 40% to bonds, and the remaining 20% to CDs. Finally, as the years go by, we'll make an adjustment to increase the amount coming out for income in order to offset the effects of inflation, which we'll project at 2% per year. The long-term average for stocks over the past 15 years has been about 2.75%. Now, over the last few years, stocks have done better than that, but it's important to remember that much of this latest run-up was a recovery of losses which occurred back in 2008 and 2009 during the financial crisis. So looking just at the short term may not give a reasonable picture of what our retiree is in for in the decades to come. The U.S. economy certainly isn't growing at 20% every year. The stock market isn't likely to either. On the interest rate front, since our example assumes we're starting tomorrow, we use what's currently available right now. We know rates might change in the future, but we really don't have a basis for knowing what those changes will be. Plus, the dollars in our example will be locked away until the instruments mature anyway, so the yield to our investor won't change. As a result, using current market is going to be our best option. For bonds, we'll assume that we're talking about investment-grade corporate bonds with 5 years to maturity. Those are paying a little better than 2% right now. For the CD, we'll assume a 2-year maturity. The current rate on those is hovering right around 1.25%. If we calculate the weighted average of these three rates, again in the proportions of 40% stocks, 40% bonds, and the rest to CDs, we get an expected yield of 2.21% for the overall portfolio. So our first scenario will be the projected results of investing $1 million at 2.21% and pulling out income which starts at $48,000 annually, then increases a little bit each year for inflation. Here's a chart showing those results. There are several items to note here, but I'll go ahead and give away the ending right now. This scenario projects our retiree running out of money around age 86. Let's dig into some of the details. First item, the very first year the amount we need to withdraw is more than what the assets produce, which means we're going to have to pull out some of the principal to make up the difference. Once principal depletion starts, it never stops unless there's a corresponding drop in the income that's coming out. And most folks simply don't have that kind of flexibility in their budgets. So having to pull out principal in the very first year is a big deal. Next item. Inflation is only going to make the situation worse, since we need more dollars of income each year to maintain the same purchasing power. The inflation adjustment drives the rate of capital depletion even faster than what we were facing from just the earnings shortfall. Bottom line, our retiree is projected to be out of money in about 20 years. More and more, the big question in personal finance engagements is whether or not the person will outlive their money. So it's probably a good idea at this point to try to get some perspective on whether or not running out of money in the mid-80s is a big deal. After all, not everyone lives that long. One useful way to get a handle on this is to look at the life expectancy tables. The one that's often used for this type of planning is included in the IRS's publication on IRAs, and that's a handy place to get a copy. Just Google IRS Publication 590 and then go look in Appendix C of that document. Life expectancy isn't so much a statement that someone will live to a certain age, but rather it's a statistics concept. It's basically the point at which there's a 50-50 chance that a person of a certain age today will still be alive at some future point. In other words, if you have a group with a life expectancy of 10 years, then 10 years from now, you would expect half of those people to still be alive. The chart in the publication shows that the life expectancy for people who are age 65 right now is 21 years. So that corresponds to a life expectancy of 86, 65 plus 21. In other words, pretty much the same point as where the money ran out in our example. The implication is that half of all 65-year-olds who go through a planning exercise like the one we're discussing here will still be alive on their 86th birthday, which of course means they're still going to need money to live on. Half is a pretty big portion in my book, so my conclusion is that this is a big deal. Clearly, we need to explore ways to earn more with the resources that are available. But we have to be careful and not lose sight of the fact that returns aren't the only thing we have to consider when weighing the options. A full analysis of investment options includes paying attention to risk factors and looking at the way the new holdings work with the existing ones from a diversification standpoint. Investors who just move from one thing to the next on the basis of a shiny possible return are usually disappointed. So even though we do need higher returns, we don't want to commit the foul of mindless return chasing. In a second, we're going to look at the potential implications of bringing some new assets into the portfolio mix. And the ones we've chosen for the example do have higher return prospects than what we've looked at so far. But that's not all they have going for them. So it's important to keep that in mind. The new assets we'll introduce here are fixed indexed annuities, asset-backed notes, and life settlement contracts. You can find detailed descriptions of these assets on our site, nostockportfolio.com. For purposes of this exercise, we've assumed that each of these new investments will earn the following rates. Now, individual offerings in a live setting often have slightly different features from one issuer to the next, so you don't get the same kind of pricing consistency that you would get with something like bonds that all carry the same credit rating. That's just one of the things you have to deal with in the alternative investment space. But that said, each type of asset has pretty well-defined ranges for normal returns, and the rates we used here would fall within each asset's respective range. If we constructed a portfolio with just these three, in equal proportions and assuming these rates of return, our expected average yield for the whole new portfolio would be 6.33%. So we have our original portfolio, which earned 2.21%, and this new portfolio, which models out at 6.33%. Now we're going to start mixing them together in order to drive our overall yield higher, which in turn will extend the number of years until our retiree runs out of money. Believe it or not, this exercise is mechanically similar to what you do every time you wash your hands or take a shower. As you know, getting warm water out of a faucet is nothing more than mixing the right portions of hot and cold water together. If you want it to be a little warmer, you can add more hot, reduce the amount of cold, or both. Steering a portfolio yield to a required level when you have two different components to work with follows the exact same mathematics. You just mix the two in the right proportion. So to get a baseline, let's look at mixing the old portfolio allocations with the new one in a 1-to-1 ratio, or half of each one. The prospective yield from this combination comes to 4.27%. If we take that yield and go back to our chart, we see that it changes the projected endpoint of the capital from 86 out to somewhere just after age 93. So that's progress. For most people, the money is going to run out at some point, by the way. The amount of money that is required to create income that's still going strong, say a century later, is simply more than most of us are ever going to see. So the real goal is to push that endpoint as far into the future as possible, which is why the move from 86 to 93 is progress. But even that might not be enough for some people to be comfortable. What if we want to push the projected endpoint out to age 100? What would that require? Well, adjusting our chart, we find out that we need to earn about 5.25%. In order to get that, we would need to remix our two portfolio components in a different ratio, just like turning on a bit more hot water to make what's coming out of the faucet warmer. To earn 5.25, we would need about 25% of our portfolio invested in the original allocation and the remaining 75% invested in the new. Now, whether or not that would represent a suitable mix for a specific investor would be based on a lot of factors. But as a simple matter of working the math to get something which should work, that's the answer to the math problem. We can't ever know exactly what the future is going to hold. That's especially true with investing. So there's no way to know for sure that a given plan is going to work out as well as it could. But sometimes we can know that what we're planning really doesn't have much of a chance of succeeding. Investments that are only supposed to pay 1 or 2% in the first place almost never pay dramatically more. Choosing something which has little to no chance of performing the required task, even if everything goes exactly according to plan, is simply the wrong choice. And it doesn't matter if it's a common choice that lots of other people make, or even one which might have worked just fine at a different point in history. The stark reality today is that a lot of the traditional investment choices simply don't have the ability to deliver the results that most people need. If you know going in that success is highly unlikely, changing course is really the only reasonable response. The financial industry has trouble stamping out alternative investments and selling them in bulk. Deals often vary slightly from one to the next, making mass production and high-volume processing difficult or impossible. As a result, most investors are not as familiar with alternatives as they are the more traditional investment options. But the fact that they're not as well known doesn't have anything to do with the way they can perform. Most investors who take the time to weigh them on the basis of merit come to see the benefits right away. And as we've demonstrated here, a move to alternatives doesn't mean you have to abandon traditional portfolio allocations altogether. You can have both if you want to. The assets you choose for your portfolio will have a major impact on the amount of income you have during retirement. If the traditional offerings look like they aren't going to be able to do the job, you owe it to yourself to spend some time exploring what else is out there. Obviously, these are big decisions. Taking some time to make good ones is a good investment in its own right. And if you need some assistance with information or sources for the assets themselves, contact our office and we'll be glad to help you. Thanks for watching and good luck.